think I fall somewhere in the middle. The general consensus is now very bearish on housing. The idea is oversupply. Demand just totally froze up because the rise in mortgage rates just completely froze, and that's all real. Whereas I think Harris Kupman would focus on the longer term, and I tend to agree with that view. I'm not as bearish on the broad U.S. housing market as I am on other things, at least in nominal terms. Certain zip codes certainly way overdone. You had certain, you had certain cities had major booms. You had local pockets where you had just euphoric bidding for housing. Bids would come in just super fast. You have more bids you know what to do with. You sell way above your initial price. I think that's behind us, and that's going to stay behind us. But I do think that when you look at nationwide average nominal housing prices, I don't really expect a big downturn. I mean, you could have a dip, you could have things like that, but I expect more of a stagnation. And so if that trends sideways in nominal terms, that'd be going down in real terms. If it trends mildly up in nominal terms, that'd be flat in real terms. And that's more the environment that I see. I think that the excess will come off, but that I think that it'll return to, okay, what pockets are underbuilt and what pockets are overbuilt. So it's very zip code dependent. I also think that due to what I said before, I think by the time we get to 2023 or so, I think the Fed will probably have paused, and I think we'll see probably a reduction in mortgage rates and potentially long duration treasuries. And so I think that that'll ease the market to some extent. The interesting thing is when this happens, right? So mortgage rates spiked, so obviously demand dried up, but also sellers dried up, because if you have a home and you're thinking about moving, you really have to think twice about that now, because if you sell your home and then you buy another home, you're going to have trouble getting financing on that at any sort of reasonable rate. Basically, you're either going to get the same home for like the same type of, the same price of home for a higher monthly cost, or you're going to have to settle for, a less expensive home for the same monthly cost. So even sellers have less of an incentive to sell in this type of market. So I think that it's more about the market being frozen than anything else. And so I kind of have a, neutral, choppy, sideways view on the market and kind of a very zip code dependent view. Different markets have different nuances. So in the United States, we pour our capital into stocks rather than real estate for the most part. And then the foreign market, they pile their capital into U.S. stocks. Kind of our capital markets are like the crown jewel of what we optimize for. Whereas a lot of the global markets is the opposite. They don't invest heavily in their stocks, but they invest heavily in their real estate. And so when they have asset bubble, it's more like in the real estate market. And China's really been, I think, at the core of this, because Chinese consumers heavily prefer real estate investments over stocks. They also like things like gold, physical metals, but really the bulk of it is real estate. And because real estate prices are so high, as well as because many of them want jurisdictional diversification to the extent that they can get it, they want to go outside their country. So they buy real estate in Australia, they buy real estate in Southeast Asia, they buy real estate in Europe, they buy real estate in Canada, especially Australia and Canada. They really influence those markets because they're not really huge markets when you think about it compared to China. And so that combination of the domestic cultures investing heavily in real estate and then foreign buyers coming in and bidding up real estate, I view those markets as rather overvalued. In a similar way that going into this year, I viewed U.S. equities as overvalued. Whenever foreign capital is heavily pushed into one area, I get quite concerned when you combine that with high valuations. So I've been concerned about U.S. equity valuations, and I've been concerned about Canadian, Australian, Chinese real estate valuations. So, I would take U.S. real estate over many other countries' real estate. But at the same time, I would seriously consider, say, value stocks outside of the U.S. compared to some of the S&P 500 that we see in the U.S. Things that are under-owned, but that are still chugging along and doing pretty well. I've been known as a bond bear, more of an inflationist. I've been, since, I kind of hinted at it in 2019, and once we actually got the stimulus in 2020, I've been firmly in the inflationary camp, and not really just transitory, kind of multi-year inflationary camp. And so I've been obviously avoiding long duration treasuries, sticking to, real assets, and to the extent that I hold defensive assets, it'd be like gold and cash. But, when you have a record bond sell-off, I mean, the first half of this year was absolutely disastrous for mid to long duration bonds, and you start to get treasuries at 3%. I started to take a somewhat contrarian interest in bonds, which again is coming from a structural bond bear. And it doesn't mean I want to hold them for 10 years, but it means on a 6 to 12-month basis, I view that the risk reward of owning intermediate term and semi long-term bonds was attractive. I can't really bring myself to buy 20 or 30-year bonds, but the kind of the 5 to 10-year range became quite attractive to me on a risk-adjusted return basis.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
I have bad news for you. If you're not rich by now, you're screwed. And if you're in debt, you're even double screwed. How so, you might wonder? Well, the sad truth is that you're working your whole life to make someone else rich. The mega corporations, the banks, the politicians, everyone is getting richer. They get your money. And what is even worse, they get your time, they get your life. You are not even in a rat race, you're in a financial prison. But what could a solution for you look like? Honestly, I don't know, but I know what a solution for me would look like. It's very simple. I use whatever money I have and I multiply it with 1,000. This could make my life much easier and probably yours as well. If you have $1,000 available and multiply this with 1,000, I believe that this could solve some financial issue for the one or the other. Of course, if you're ugly, you would have to multiply it with much more than 1,000. My name is Markus Dahn, and this is what I decided to do. I decided to 1000x my money. This is not a joke. I know what you may be thinking. What is this guy talking about? How should this work? This is not possible. Well, I made a detailed video where I laid out my plan. And some clever folks might even want to look at this plan and copy it and do exactly what I do. This is just a little hint on the side. You have two options. You leave, you forget what you have seen. You do whatever you're doing and you hope that somehow you get some other results. Good luck with that. Or you click the link below the video. You enter your email address because I'm not showing this to everybody. You at least watch my video on how I plan to 1000x my money. The choice is yours. Make the right choice. Join me. See what a different future you could have. See at least how I intend, how I plan to do the 1000x. So click on the link below, enter your email address, and I see you on the other side. Your Markus Dahn.